Hello, everyone. In the interest of time, let's start this webinar. Today, we have Mr. Kunal Moktan from a very, I would say, innovative product, which, is named as India's first PMS, which is focused, in the space of fixed income and, is trying to deliver double digit returns by investing in listed REITs and listed InvlTs. It is, something which is a real innovation for debt focused and fixed income focused investors. And obviously, we know that at present, this is absolutely a new concept. There is yet to be seen, the entire emergence. There are, as per my knowledge, only, majorly 3 popular REITs and I think 2 to 3 InvlTs which are listed at present. Few names which I know of are like Brookfield being one and Embassy being another one. But obviously, in this webinar, we would like to understand in detail from Kunal Moktan, who, is a very popular name in this particular space. He has been co-founder of, erstwhile a very popularly known platform, Property Share, which now has got migrated and is known as Alt platform. And, he has launched India's first InvlTs and REIT based PMS. And I'm equally keen to learn and understand from you, Kunal. So I hand it over to you from here while, you initiate the conversation and try to you give the first overview about, what is the basic understanding and basic meaning of REITs, InvlTs, and what are you trying to achieve through this particular PMS. In the meanwhile, I'll try to, bring the presentation live. Over to you.
Thank you so much, Kamal. Thank you for that introduction. And please do bring up that presentation so that I can also speak about it. Just to give a brief background, I started my career at Blackstone, the private equity fund that Kamal just spoke about on the real estate side, and we invested close to $1 billion of capital into Indian commercial real estate, most of which got IPO'd as a REIT later on. And he mentioned 3 REITs, but there are actually 5 listed REITs today on the office side. One retail REIT, and on the InvlT, we've got another 5 listed InvlTs, and there are a number of unlisted InvlTs. 2 more REITs are coming up for IPO, the Bagmani REIT and the Panchsheel REIT, again sponsored by Blackstone. That will make it a total of almost 7 REITs that will be in the market. Currently, they have almost $27 billion of assets under management across these sort of REITs, and they have a combined market cap of over $17 billion. And on the InvlT side, they have almost $80 billion of assets under management, so much bigger, with a $4 billion market cap. After spending 8 years in Blackstone buying and selling commercial real estate, I started property, what was earlier called as Property Share, like Kamal mentioned. And this was the fractional ownership platform where you could purchase a share in a rent-yielding commercial warehousing retail asset directly, instead of going through a pooled vehicle like a fund or something like a REIT, and own a piece of that real estate yourself, and which was very popular. We became the largest. We were the pioneers of that product. We managed almost 1,500 crores of assets under that product banner. And a couple of years ago, SEBI sort of reached out to us and said, look, what you guys are doing in securitizing real estate is great. Can we form some regulation around it so that we can give you access to the capital markets and also sort of protect investors from a regulatory point of view? So we submitted a consultation paper to SEBI, and SEBI also then came up with 2-3 consultation papers before finally notifying the small and medium REIT regulations in March of 2024. We were the first to apply for that license. We were the first to be given the license. We were also the first to list the first property under that license, which was Prop Share Platina, which we listed on the National Stock Exchange in December of 2024. Last year is 353 crores. And Kamal, if you can go to slide 15, I can talk a little bit about who we are. So which is the portfolio manager section. And then in December, sort of we listed that. And then we were again the first to file the second one, which was called PropShare Titania, which was much bigger, 470 crore asset in Thane in Mumbai. It leads to a multitude of blue chip tenants like Aditya Birla, Convergys, Toshiba, Hitachi, and so on and so forth. And that was completely oversubscribed as well. That is now also listed on the stock exchange. So you have 2 SM REITs listed. You've got 5 REITs and you've got 5 InvlTs. And both the SM REITs have been done by PropShare. And we are now sort of trying to get to the third SM REIT scheme. Now, the way these are, just to talk about the SM REIT, the way that is sort of set up is you've got an investment manager like an AMC, which can launch various schemes. Each scheme is an IPO of an asset. So therefore, there can be 20 schemes with 20 different assets. We've done 2 right now, but there will be more coming. So just to continue with the background of, that is one part of our business, which is property share, which does the SM REIT business. And of course, ALT stands for alternates. ALT is a platform that gives individual investors access to various alternative assets, one of which is the SM REIT. And the other is the product that we are going to talk about today, which is on the publicly listed side. We have a product called ARIPS, which is the Alt REIT InvlT PMS. It's the first and only PMS in the market today that invests in a portfolio of REITs and InvlTs that are available in the market today. Alt is an institutionally backed company. We've got Westbridge Capital, which owns 30% of Alt. We've got Lightspeed, which is a US-based fund, which owns 10%. And we've got BNext, which is a Japanese fund based out of Singapore, and an Indian fund called Pravega, who own a majority stake in Alt. As part of our team, we've sort of invested in $3 billion worth of assets over 35 years, and we manage close to 2,200 crores of investor capital currently on the platform across various products. If you go to the next slide, Kamal. So this is the sort of the listing ceremony of the first SM REIT, PropShare Platina. It was a landmark listing, the first time somebody has ever done this in the world. We successfully funded and listed this office building in Bangalore. It is now currently listed. It's called PSP Platina. That's the ticker code on Bombay Stock Exchange. If you go to the next one, that's the second asset that we did in August, which was last month. We listed this on BSE again. This is a platinum LEED building in Thane in Mumbai. These two, like I said, Aditya Birla, Hitachi, and so on. Together between these two, we've done almost 820 crores of assets. If you can go to the next slide, we've got, this is the stuff that we sort of do on the platform. We've got private real estate, which is what we do on the SM REITs, we used to do on the erstwhile FOP platform. SM REITs, which is our primary product these days. Then we've got warehousing, which you buy in the UK. And we have an alternative investment fund, CAT2, called Alt Yield Cap Fund. First one, which we've already invested. Second one, we are closing in November. And we are launching private credit in the next month, also on the platform, where investors will get access to private credit. That's the team. That's myself and Ashim, co-founders. Rahul heads the publicly listed product team. Every product is headed by a particular person. The private credit is headed by someone else. Rahul heads the ARIPS and the public portfolio part of Alt. And just moving on to our advisory board, we've got Vikas Khadloya as the next slide. Vikas Khadloya was the former CEO of India's first REIT and ex-Blackstone. We've got Mr. C.B. Bhave, former chairman of SEBI, Mr. Benjamin Cassie, an investor in UK and Indian real estate for 20 odd years. And so on. So that's the brief background about ourselves. Now, let me jump into the product. If we can go to the very first slide, or rather maybe the one which says why ARIPS, which is slide number 1. We felt like there was no product that helped investors get access to this amazing profile of trusts, REITs and InvlTs. If I were to go and buy a REIT today, I would definitely be more knowledgeable about it, given the fact that I've bought a lot of these assets in these REITs when I was at Blackstone. For 20 odd years, I've been investing in commercial real estate and real estate in general. And it would be easy for me to, let's say, or one would think that it would be easy for me to go and sort of see which ones to buy. But it is not. When I tried to buy myself some of these REITs, I realized that there are lots of information, and a lot of work is required to find out how and which REITs to buy in what proportions. Now, one could just go and buy everything as per market cap, but that might not be the best strategy going forward. If you actively manage a portfolio and you know which ones are trading at which are cheaper and which are not, then you could create a portfolio which will give an alpha to the investor. For example, today I know that Nexus, the retail REIT, is definitely overpriced. I feel like the yields that it is trading at is not justifiable in terms of purchase price. But if I look at the other REITs, Brookfield, Embassy, they are trading at decent discounts to net asset value, a good dividend and NOI yields, and there is a chance of upside in them. So we said, look, why don't we create a product where we go and do all the research on behalf of investors. We try to find out which REITs and InvlTs are undervalued and get them and build a portfolio in proportions which are quantifiably identified, and say that, look, this is something that is going to generate alpha for investors going forward. And this product is so great because it's a hybrid asset. It behaves like a coupon bearing asset, like a bond, and at the same time it also has equity characteristics, and the way that works is that you've got a REIT which gives you 6 to 7% rental yield, dividend yield, directly to your accounts every year, which grows by 5% because the rents underlying these assets are also going up by 5%, and at the same time the value of the underlying real estate goes up every year, because of which you also have capital appreciation. So you make rental return and you make capital appreciation. Unlike equity, where you only bank on capital appreciation, or unlike debt where you only have coupon, here is a hybrid instrument that gives you both. And it's not going to make you 20% returns a year. If it makes it great, but between 12 and 15, 16% compounded rate, that's a very powerful rate of return on any product. So that's how we sort of came up with ARIPS. And the reason why we think ARIPS is good is, like I said, current income. It gives you sort of 8-9% yield every year, because the InvlTs give higher yield than REITs. They are all institutional assets. All of these assets were bought by institutional players like Blackstone, Brookfield, Rahejas, and so on. It's SEBI regulated. In fact, there is dual regulation. REITs themselves are regulated by SEBI. PMS is also regulated by SEBI. So any investor investing in a PMS on REITs has dual regulatory oversight. It's very liquid. All of them are traded on the stock exchange. So you want to get your money back, you can do that in T+1 day. You can sell all the assets and get it back. It's well diversified. We ran the correlation between REITs, InvlTs, and Nifty, and it's only 0.23. So when the stock indices are going down, it doesn't mean that REIT InvlTs will go down, and that's because of the hybrid nature of the instrument that I spoke about. So very low correlation between the equity indices and this product. And lastly, very low volatility. If I look at volatility of the Nifty, let's say it's the standard deviation, versus the volatility of this portfolio is 33% lesser. So your capital is safer, it's less volatile, it's not as correlated with equity as you want, neither is it correlated with debt, but it gives returns like equity. So in that way, it's a fantastic sort of product to be in for any investor, whether you're in your 30s trying to build wealth, or even if you're in your 60s trying to build some retirement income. It's sort of suitable for all sorts of investors like that. If you go to the next slide, I speak a little bit more about the hybrid returns of this asset. We try to see from the time the first REIT got listed in 2019 to today, if we look at the entire index and you had just bought it on the basis of market cap, how much would it have returned? It would have returned 11% per year from 2019 to today. And this was done a couple of weeks ago. There has been a big run up in this sector in the last 2 weeks because of the equity classification of REITs, which I'll talk about a little later, that SEBI sort of came up with. But if you look at the Nifty return here, it's 14.6% over that time. If you look at the debt mutual fund, 7.7%. If you look at fixed deposit, 6.6%. Now note that all of these are fully taxed at 30%, whereas REIT returns are not taxed 100%. Part of it is return of income, and part of it is return of capital, which is not taxed. So the actual tax rate on returns is much lower than the other products. So, and if you look at the light green component of these bars, the debt bars, the first three bars have only light green component and no upside. So that's only the interest component. Whereas here in the Nifty REIT index, you got 8.3% coming out of dividend yield and 2.7 coming out of capital appreciation. If you look at equity, it's all dark green, very little dividend yield. As you all know, 1.4% dividend yield and almost 13.2% of capital appreciation. So a great product that sits in between equity and debt and gives you safety of capital, less volatile, very less correlated to the equities, and gives you 11% compounded return. We love that. If I look at the same in the form of a chart in the next slide, you see that if you had invested 100 rupees in 2019 when these indices were formed, the Nifty would have gotten you to 224. A debt government security would have taken you to 145. And this index would have taken you to 186. And see the volatility, very little volatility versus the other sort of products. If I go to the next one, why we think this is a good asset? Look at the quality of the assets you're getting. You're getting Embassy REIT. You're getting some of the best quality parks in Mumbai, Bangalore, and Pune. You got Embassy Tech Village. You got Embassy Golf Links. You got Manyata Business Park. You got Embassy Tech Zone in Pune. You got Express Stars in Mumbai. You got HCC 24/7 in Vikhroli, and these are all multinational blue chip tenants. JP Morgan, Wells Fargo, Goldman Sachs, Amazon. If you look at the Mindspace REIT, it's all of Hyderabad. Again, fantastic tenants. You got Brookfield REIT that gives you the NCR exposure. If you look at the Nexus Select REIT, that gives you access to all the big malls around the country. So it's a great play on consumer. If you could stick to that slide, Kamal. If you look at Knowledge Realty Trust, which was the last one that just got listed, by the way, got listed at 100. It is already at 113, a 13% appreciation within less than a month. That's a great return. And this gives you another great portfolio and two more coming up here. Totally, you can get access to the entire office and retail market in the country through these REITs. If we can go to the next one, the InvlTs is a play on the infrastructure of our country, which has been a big push from Prime Minister Modi and the BJP government over the last 10, 15 years. Number of roads, assets built has been tremendous. There's now a way to monetize them by doing it through an InvlT. If I talk about any one of these, so it's basically, here is a road. There can be two kinds of contracts. I can either say, I'll pay you to build, you pay 40%, government will pay you 60%, and then you can recover your 40% over 10, 15 years at a 15% IRR, right? Or it could be you build, take all the tolls for the next 30 years concession, and in case numbers don't match, we can extend that concession, so even better. So you can own roads, you can own power lines, you can own ports, you can own fiber optic cables, you can own a lot of infrastructure through these InvlTs. You can get access to that. So it's a great play on the country and the growth of India in general. If you go to the next one, I talked a little bit about the dual regulatory structure of PMS and REITs and InvlTs. On the next slide, you'll see some of these advantages. So if you look at the PMS side, we can only do liquid securities. So you can sell whenever you want. You can exit whenever you want. There has to be mandatory client level holding. So your investment will go into your demat account through your bank account. So we have control over that demat account, but all of it is in your demat account's name. So you're not giving capital to somebody else to manage on your behalf. It's all in your demat account. When sold, will come to your bank account. There's high disclosure, very good governance. There's access to service grievance mechanism. And on the REIT InvlT side, they have to distribute 90% of income every quarter. They have to have at least 80% rent generating assets. They can't be buying only land or under construction assets. They can only do 50% leverage. You have to distribute half yearly, although all of them do quarterly. So very good regulated structure to invest in through the regulator. If you go to the next slide and we talk a little bit more about the liquidity, almost 80 crores get transacted across these assets on a daily basis. And this is before Knowledge Realty Trust. So after it has come in, this will be even more. So you can sell and exit at any given point of time. If we go to the next slide, which I talked a little bit about the tax and how that 11% return is actually much more if I look at post-tax return versus others. When a REIT distributes income, it distributes two kinds of income. One, capital gains, which is obviously, you buy for 100, like I said, in Knowledge Realty Trust, it's at 113, you sell that stock. If you hold for more than 1 year, it's only 12.5% capital gains tax. Where else will you get such a low tax on your investment? In which product gives you such a low tax? I mean, same as equities, you get that benefit. Now, until last year, you had to hold it for 3 years to get this benefit. But the finance minister in the last budget changed this to 1 year, which is great for REITs and InvlTs. The other distribution is the yield that we're talking about. Now, that yield comes in two ways. If you see the top bit, that sort of has two arrows going there. One is interest, which is rent comes in, distributed as interest, and part of it is distributed as repayment of capital. So it's a little technical, I can get into it, but what it means is that part of that income is not taxed at all. So out of the 8, if you see the next bit, which is the 8 rupees of distribution, typically it is 2.4 rupees repayment of capital, 2.2 rupees of dividend, 3.4 rupees of interest. So on the top 4.6 rupees, there is no tax. On the 3.4, you have to pay your marginal tax rate. So if you're in 30% bracket, you pay 30. But on most of it, there is no tax. So therefore, that 11% post-tax is like 9.5%, 10%, which is unbelievable in terms of post-tax returns today. So it's a great sort of tax product. If you go to the next one, I spoke about that diversification and the correlation, which we measured through a beta. We did the volatility through standard deviation. You see that, it's only 0.12 is the sort of standard deviation here versus 0.1 is 33% less volatile than the equity indices. And as far as the correlation, the beta is concerned with equity and GSECs, I mean, equity index could crash next year to like 30%, but that's not going to affect a portfolio like this because it's only correlated 0.23 times to the Nifty. And the reason for that is that dividend yield. If a stock like Embassy crashes by 50%, theoretically, the yield will go up by 100% from 6 to 12. So there's no way that happens because suddenly these assets will trade at half the value of the real estate, and that's the entire reason why the correlation is so low and volatility is so low. If you go to the next slide, why should we invest in REITs? I mean, India is the GCC capital in the country today. You must have heard of it. All the big multinational companies, whether it's Amazon, whether it's Cisco, whether it's Apple, they are all their largest offices outside of their home country are in Bangalore, Pune, Gurgaon, Noida, Hyderabad. Microsoft, Google, Goldman Sachs, Wells Fargo, HSBC, Deloitte, Walmart, Citi, Bosch, and we've not even scratched the surface. Only 20% of the total multinational cohort has come to India till now. And why? Operating costs are lowest. If you look at the top right-hand graph, operating costs in India are 19 versus, let's say, 100 as the base for a US tier 1 city. So 80% cheaper than the US. It's 60% cheaper than even a sort of Eastern European country like Prague. Lots of engineering talent coming out every year. It's not really the low cost sort of work which has moved on to Philippines and Manila and so on, which is the calling, but now it's more analysis, research, AI, all of that stuff happens in India today and it's continuing to happen. Look at the number of GCCs has grown in India from 700 to almost 2100 in the next year or so. So, as more of these guys come in, they want real estate, they need more offices, rents go up, and therefore returns sort of go up. If you go to the next slide, why InvlTs? I mean, we've seen the government plan and how roads and other sort of infrastructure networks have gone up in the country. If you just look at the outlay for roads, the first graph, it's gone from, when the BJP government in the first term at 11 to almost 33 today, 3 times. Road construction per day in kilometers. Look at that. It's kind of going up every year. Per capita electricity consumption. In a country like India, with a big population, electricity consumption goes only one way, and that's up. And the more transmission lines you own, the more profitable they are. If you look at electricity generation, and these are some of the sort of things that we are talking about. So, it's a great way to own real estate as well as infrastructure assets in the country. Now, let's talk a little bit about the ARIPS portfolio. If we sort of go on to slide number 12, we've sort of graded out for the moment, but we've sort of come up with a very quantitative formula for selecting these REITs and a very qualitative formula. So we've gone through, for example, the sort of screen is not visible, Kamal. So maybe, you want to go back one more slide. Yeah. So it's going to be a portfolio of 8 to 9 of these REITs and InvlTs that we have already created. And we've gone sort of deep dive into every one of these assets. Let's take Embassy REIT, right? We've gone and seen every asset that the REIT owns. We've gone and seen where these assets are located. We've gone and seen what is the occupancy of each of these assets. What are the in-place rents that are there in these buildings versus the market rent, which gives you a potential of how much you can reprice the asset to when the rents come up for renewal. We've looked at what is called WALE, the weighted average lease expiry. When are the leases expiring? Is it only 2 years or is it 6-7 years? The longer, the better it is. We've looked at what are the vacancies in that micro market. We've looked at if I were to buy these buildings today, how much would I pay for it? And therefore that'll tell me what the net asset value is on a first principles basis. And we compare that to the market cap to see, is it undervalued or overvalued? And then basis of that, we look at what is the leverage of each of these assets. What is the leverage that the REIT has taken so that we know how much leverage is there and which is a measure of risk. We try to look at that. We look at qualitative factors like how good the quality of the buildings are, when the construction was done, who the developer is, how good is the corporate governance. So we look at all of that, and then we sort of use a quantitative solver to see where we should allocate how much. You look at Sharpe ratios, the returns it has given over the last 6-7 years, and try to come with a portfolio which will beat the 11%, which the index would have given for a portfolio like this. And we come up with this great portfolio for investors. And of course, we don't invest only, we also manage it. On a day-to-day basis, we track these assets, we follow the news, we see what's happening. Recently the Embassy CEO had to be let go because of a SEBI order, and then there's some corporate governance issues. We sort of know exactly what is happening. We've got insiders like the advisory board that I talked about, who've been in these REITs and who manage these REITs for so many years. So and every quarter we look at we attend all the analyst calls, we sort of read all the research reports, we go and visit these assets, and we rebalance the portfolio for investors so that if certain things become more costly, like I said, Nexus, I feel like is more costly now, we should get out of it. And some things that become cheaper, like let's say Brookfield, we buy more of that and less of the others, so that we maintain a very active portfolio allocation that gives that alpha that investors are looking for. If we go to the next slide and quickly give you an overview of how the model or the returns will look like, you'll put in 50 lakhs, let's say, which is the minimum ticket size in a REIT. You will get about 4 lakhs a year, which is the dividend yield from this portfolio, which is 8%. And at the end of 3 or 4 years, or even 2-3 years, when the stock price goes up, we feel like you can make another 3-4% a year in capital appreciation. So you'd end up making 12 to 15% unleveraged IRRs in a product like this with very little risk. Now let's look at the key terms of the PMS, which is the next slide. It's a discretionary portfolio management scheme. Alt is a registered portfolio manager with SEBI. It has been for many years now. The minimum ticket size is 50 lakhs, which is governed by SEBI regulations. We will be distributing every quarter to investors. The asset classes we will be investing will only be listed REITs and InvlTs. Now here again, we could also add SM REITs. The 2 SM REITs are currently trading at 99% yields. We ourselves have bought those SM REITs to the market, and we are investors in those SM REITs. The regulations require the investment manager of the SM REIT to invest 5% of their own capital for alignment of interest. So in the 820 crores that we've listed through those 2 assets, we've actually invested 40 crores of Alt's own capital into those assets. So we know how good they are. We didn't want to include it here because we want to keep corporate governance clear. We don't want to be seen as promoting our own listed units through this PMS, telling investors to buy that PMS, or rather the PMS investors to buy that REIT. Frankly speaking, it doesn't really affect anything because that's already listed, and we can't sell our 5% there for 5 years. We're locked in. I don't think investing here and there will increase the price, but sort of don't want to do that at the moment. If investors want that allocation in their PMS, we could talk to them and we could sort of create a portfolio separately for them on that. But for now, it'll be listed REITs and InvlTs. Our management fee depends on how much you invest. If you invest the bare minimum 50 lakhs, it's 0.8% per year. That's what we will charge for all the management. So make sure that the sort of lights are on. And then on the performance side, this is where we feel like we can really give performance to investors. Up to 8% IRR, we don't charge anything. Above 8, we charge 15 if you invest 50 lakhs, 12.5 if you invest 2.5 to 5 crores, and 10% if you invest more than 5 crores. And this is very important. Lots of people say, forget the performance fee. Why are you having the performance fee? But if you don't have the performance fee, the portfolio manager is not really incentivized to do anything with your portfolio. If I'm only making management fee, I'll just make sure that you don't exit. I'll just say, okay, keep giving him higher dividend yields, keep giving him sort of cash on cash returns. But let's ensure that we don't sell any of these, because anyway we're not making anything off of those. And I feel that's not a very good strategy to go with. Every great alternative investment manager in the world, be it Blackstone, KKR, they have a performance fee. And that is the fee that makes sure that we do the work involved to get the returns. And we only make that fee when you make more than 8. So it incentivizes the portfolio manager to drive returns higher, to get you higher returns, so that you make more on your capital than you could have made for similarly risk-adjusted products in the market. No exit fee for the first 2 years. After 2 years, absolutely zero exit fee. If you exit quickly, this is not a product one should exit quickly, because less than 1 year, there's already a short-term capital gains tax of 20% instead of the 12.5% I spoke about. Then you pay a 1% exit fee. There's absolutely no lock-in. If you want to pay an exit fee and exit within 2 days or 3 days, absolutely you can. So that's about it. The next section is about the portfolio manager, which I already spoke about at the beginning of this presentation. So I hope that was helpful. And now, Kamal, I think if I'm not wrong, we're going to open it up to questions, right?
Perfect, Kunal. I think this was very detailed and very insightful and very, I would say, smooth presentation. It seems that you have made each and every slide, so you are aware of each and everything. So absolutely quite clear. So foremost, I would want to ask one question from on behalf of clients and or anybody who is logged in right now. Let's first understand the return aspect. The expected return aspect of the fund. The return is comprised of two components. One is the yield, and second is the capital appreciation. So while yield is something which is kind of, one can foresee that based on the rents, but the capital appreciation part of real estate, which is obviously going to add, how realistic is that? When we are saying the expected returns are in early double digits of say 11 to 14%, obviously it is comprising of both of components. And if investors have to seriously compare this as an alternative to maybe a passive equity fund, which is like trying to match up to nominal GDP or trying to match up to kind of, I would say, a large cap index, and that the taxation is relatively more I would say optimized here. So this is a very, I would say, realistic question which I would want to ask if I have to invest that passive component of my portfolio to this particular fund.
Capital appreciation in real estate is very real. It happens all the time. As we know, we all own residential, commercial in some way. And this is nothing but a way to own the underlying real estate. Ultimately, it's a securitized product where through the trust, you are owning the actual real estate. Now, we don't have tens of thousands of crores to buy this business parks like Blackstone, but we can buy a piece of it for 100 rupees or 1,000 rupees by buying these units, right? And the way capital appreciation works at a very fundamental level in an office building is you buy an office building for 100 rupees, it gives you 10 rupees of rent. That's a 10% yield, right? So great, I'm making 10%, but how will I make more money on the appreciation? Now, the underlying lease in India itself goes up by 5% every year or 15% every 3 years. Those are the two sort of options that tenants have. So the 10 rupees that you get at the time of buying goes to 10.5 rupees at the end of a year, which is what you will get. Now, if you want to sell that 10.5 back to the market at a 10% yield, you will get 105 rupees. So basically, you made 10 on the rental income and you made 5 on the capital appreciation. So you made 15% returns. At a very fundamental mathematical level, this is how you'd work, because the yield would remain the same at 10%. I bought at 10, yield went to 10.5, I sold it back at 10, and therefore I'm getting 105. That's exactly what happens here, but in a basket of properties. Every year, the dividend yield or the yield goes up by 5%, 6%, because the underlying rents go up. And when that happens, the market prices it back to the dividend yield that the market is sort of okay buying it at, depending on government security rate, inflation, etc. And therefore, the price goes up. Now, when Embassy listed in 2019, it listed at 300 odd rupees. Today, it is at 410 rupees. That's a 35% appreciation over 5 or 6 years. So if you see, Knowledge Realty Trust is an outlier. It listed at 100 just 1 month ago. It's already at 113. So 13% appreciation in a month. That's a crazy sort of IRR. It's a huge return. And similarly, if you look at Raheja, each one of these, that chart that was there, which shows the yield component and the capital appreciation component, it shows that 3% coming from capital appreciation. But the great thing is, it's not 9% appreciation and 3% yield. Majority of the return is coming from that yield, which is sort of fixed. We are only betting on a very small percentage to come from capital appreciation. And if a manager manages that even better, the alpha on that can be another 200-300 basis points, which I think is very easy to get, to answer your question, in this portfolio.
Sure, Kunal. I think, we have been getting messages on the chat as well. Your presentation was quite interesting, nice, and insightful. And moving on to next question, pertaining to the risk aspect, right? You mentioned that there are 5 listed, I would say, instruments already. 3 in the REIT and 2 maybe in the InvlTs.
No, 5 listed REITs and 6 listed InvlTs. So there are 11.
Okay, perfect. So if there are 11, how would you kind of tackle the diversification aspect of it? It's like, where is the fund management aspect involved? Because a fund manager who has to act and select from a large universe, and then obviously, he should be kind of deserving a fixed fees and the performance fees. But if the universe itself is comprising of only 11 assets, so why and how a fund manager plays a role? So
fund manager plays a very important role, because today, if I want to allocate, like I said at the beginning of the presentation, my capital to a REIT, there are 5 REITs, 2 more coming, and another 7 InvlTs and 2 SM REITs. Now, how will I go and see which REIT or InvlT to buy? I can blindly go and buy one which somebody has told me about, like Embassy or Raheja, because I live in Hyderabad. I've seen Raheja and I feel maybe it's good, but who knows how it's trading and so on. And therefore, your decisions are likely to be suboptimal versus what the actual portfolio should look like if you knew, or a professional would invest in this portfolio. So while the REIT universe in terms of number might be small, in terms of value, we are talking about $45 billion of market cap between these two. And the first choice that the fund manager has to make is, what percentage should I invest in REITs and what in InvlTs? Let's sort of think about that. Should it be 80-20, 70-30, 60-40, 50-50, 10-90? That's the first decision you have to make. Now, once you've made that decision, let's say it's 60-40, out of the 60 in REITs, which REIT should I buy and in what percentage? Should I just buy 12.5% of each of these 4 REITs or 5 REITs, or 12% of each of these 5 REITs to make it 60? Or like I said, Nexus is trading a lot more expensive. I should get rid of that and try to buy more of something which is cheaper, which I feel like will make more money. So 30% in Embassy, 5% maybe in KRT, 10% in Nexus, and so on. So that decision again has to be made by a professional who understands this market and this underlying real estate very well. And after that, when to keep balancing these portfolios, how much to sell, how much not to sell. Recently, we sold Nexus, like I said, in the last few days. It's run up to 158 rupees. Feel like it's too expensive. You look at the metrics, the yields have gone down, but market doesn't see it yet. It is going to see it. Nexus cannot be at that level for long. It has to come back down when this whole thing dies down about equity and indexes and so on. And at that point of time, we'll buy again. So I feel like it's a fund manager plays a much better role in a concentrated portfolio of 10 to 11 stocks than in like thousands of stocks, where the fund manager himself doesn't have the resources to go and analyze every single stock. Here we know every single asset in every single one of these REITs and InvlTs, and that makes us a very, very significant player in this market.
Sure. Is it a passively managed fund, or you will be actively kind of aligning between REITs, InvlTs, and in between all the assets?
Yes, it will be active.
Okay, and how would you determine, active managed strategies, have some learning curve which has led to some philosophy, some strategy. So what is that philosophy and strategy based on which, you will be doing this active management?
Our biggest advantage in this is that we know this market inside out from the beginning. I started buying real estate when real estate was not allowed to be bought in India back in 2007. There were various regulations. We had to do all sorts of things in Blackstone to invest in some of these office buildings. And even then we knew that buying this Manyata business park at 5,000 rupees a square foot, which is what we bought Manyata at, today it's at 20,000 rupees, is good value. And we bought it and we hope that at some point of time a REIT regulations will come in. We petitioned SEBI, we got the REIT regulations, we listed the first portfolio of ours through the embassy REIT, and Blackstone made lots of money in that. Now we understand the asset and the portfolio of these REITs very, very deeply, and that is something that helps us actively manage it. And we have our own private real estate team as well, which goes out and buys commercial real estate for SM REITs. So we are in the market all the time. We know, we are sort of talking to brokers all the time. We are talking to landlords. We are talking to institutional investors. We know where the market is moving. Outer Ring Road in Bangalore, Kharadi in Pune, or a particular sector in Noida, and so on and so forth. So we know where these things are moving and where the REITs are, and I feel like that is something that helps us in actively manage this sort of portfolio. And in terms of sort of what our strategy, or having launched this strategy, a question around that, we've seen this market for 20 years. We know how sort of it moves. So we feel like this is not something that we are getting into for the first time. We already knew the underlying. It's just a wrapper around it, which is the PMS wrapper, that has changed.
Sure, Kunal. So, again, I'm trying to realistically moderate, because I know, if I was the investor, I would have these questions in my mind, and that's Absolutely. What I'm trying to ask, from client's point of view. So next question that comes to my mind is that Indian investors are always, I would say, used to selecting from variety of options. In this case, we are talking about 11 assets, which, obviously value wise are very huge, and hence, make up for it. And in terms of selecting, say, your product versus any other way to invest into REITs and InvlTs from investor's point of view, how would investor kind of convince himself that, when he's giving money to you versus something else, which he's not even aware of, is there any way that client can compare and make a better and maybe well-informed decision, while obviously, he's selecting and going with you as a PMS, for this particular goal of fixed income in his portfolio?
See, I mean, your questions keep coming back to that 6-7 assets and so on, Kamal. The thing is that there is, first of all, no product like this in the market today. There is no product. If you want to go and buy a portfolio of REITs, you can't. It's not possible. There is no product. We are the only ones. I don't know why, but people have not done it, and we feel like they should. And the second thing, which I've answered again previously also, is if you were to go and buy REITs and InvlTs, which REITs would you buy?
No, I'm not aware, honestly.
Like, would you buy Embassy? Would you buy? You don't know, right? You've not done the analysis. You don't have the time to go and spend and read annual reports of each of these to see 20 buildings that each of them own, what the rents are and who the tenants are, what the lease expiries are. You don't. So that's the whole sort of value add that we are bringing here. We know all of them, and we are telling you which ones you should invest in so that you make those returns for that particular allocation that you're making. That's the whole point.
Sure, Kunal. I know I'm just trying to make it realistic. I gave you that, disclaimer, because investors would have all these questions, and unless, real questions are asked, investors, will keep them in their mind. Now, obviously, this is something which is unique, innovative, and you are the, I would say, pioneer in this space. What is your, I would say, foresight on how is this kind of industry coming up? There are so many asset management companies in India, so many alternative investment funds. When you're saying, you are also kind of astonished that others are not delving into it, and government is giving push. And obviously, we want India as a economy, as a country, to grow both on real estate as well as on infrastructure, which is a real requirement. So obviously, there would be a push from government, which is right. But then why is it that, there are not other platforms or other players? It is like untapped market, as you are presenting, but it kind of, brings a kind of this question that why is it so, that why is it untapped market, for last 5 years, like since 2019, these listed REITs have been there. It's already 6 years. What according to you has been the reason, for only you attempting to initiate first PMS, which obviously is a very innovative and right, I would say, product, and fulfills a very real need. And I'm really kind of, looking to myself, maybe considering to invest. And from that point of view, I'm just wanting to understand this aspect.
The answer to that question is critical mass. An industry has to reach a critical mass before something happens. And up till the last year, that critical mass has not been achieved. Up till last year, there were only 3 REITs that were traded in the exchanges. It was only in the last couple of years that we've suddenly had a retail REIT. We've had KRT that has come in, and we have a bunch of InvITs that have come in. And now it just requires one player to start this process before it sort of snowballs into a much bigger portfolio. That is one reason. The second reason is the recent sort of announcement where these instruments were always classified as hybrid/debt by SEBI. And now, last week, SEBI has passed a landmark sort of notification, which might have gone unnoticed by a lot of investors. They have now said that REITs will be classified as equity. Now, what does that mean? It means that mutual funds who can only invest in equity products can now buy REITs also in their portfolio. That's massive. Till now, they could not buy REITs. If you're an equity mutual fund, you can't buy REITs because they're classified as a hybrid security or debt security. You couldn't. Now, mutual funds can buy, equity mutual funds can start buying REITs. Suddenly, spotlight is on the sector. Second, up to last year, a mutual fund could have a maximum exposure of 10% to REITs and InvITs in its portfolio. In the December board meeting of SEBI, they doubled this from 10 to 20. That again is huge. Now you can have up to 20% of your portfolio in REITs and InvITs. I have met the SEBI several times, of course, as an SM REIT player. And SEBI feels that the REIT InvIT market will be bigger than the equity market going forward in India. And I don't disagree with that. I think it's a huge, huge market. So therefore, now, so I need to answer your question. It has reached critical mass in terms of the push by the regulator and the government of making this asset class more mainstream. And second, because the number of REITs, InvITs, and SM REITs have suddenly now reached a critical mass in terms of value, $50-60 billion. So there has been a lot of news, articles, etc. about these REITs now. And because of which we could be the first pioneers. We love doing that. We've always done that. Even in SM REITs, we were pioneers. But I feel like, others will follow here on this. But maybe, it'll take some time. But we feel like the final thing is you also need people or portfolio managers who understand this product very well to be able to come up with a product like this. A normal equity mutual fund is very different from a REIT. A REIT asset itself is different, like I explained. You need to really understand real estate investing to be able to do this at a securitized REIT level like we do. So I think these are the 3 reasons why this is the right time and this strategy has come up.
Sure, Kunal. What are the risks involved, from investors' point of view, in terms of aligning the expectations? Obviously, it's a fixed income instrument, and hence question of risk is important because in fixed income, investors expect linear returns. Yeah. You have shown low beta, you have shown low correlation, which absolutely conveys the answer statistically. Yeah. But still, beyond numbers, what are the realistic, I would say, risk-related expectations that investors need to be informed about?
See, the risk that I feel as somebody who's been close to this industry for a very long time is that I particularly sort of abhor is the corporate governance. I feel like that is something that people ignored, and that is something that you need to keep a very close watch on. A lot of these REITs are developers and private equity funds exiting their portfolio and to get their returns, right? So they've done that, they've made the money. Of course, they still own a large part of which they will sell over time. Blackstone just recently sold all of its sort of shareholding in Embassy REIT after 5 years. But what happens is that these developers, they are always sort of doing things like buying assets through the REIT, their own assets through the REIT at a much higher price and giving themselves exit in the asset that they own, let's say, in Pune or something like this. And you have the CEO of a REIT sort of leaving because of some corporate governance issues. If on paper, it's great. It's going to be rented, rent is going to come in, that rent is going to be distributed to investors. We're going to make 7-8% and we're going to make capital appreciation. If the 7-8 comes and that doesn't flow through to the investor, it goes somewhere else, then that is not great. And that is something that, we keep a very close watch on. I feel like that then leads to a situation where the returns are not as good as what we had expected. If I look at Embassy REIT, the first REIT, there were all sorts of financial engineering done to have a yield which was very high initially. For example, the bank, the HDFC, who was the primary lender on each of these assets, it was negotiated that they will not charge an EMI for 2 years. Right, it will not charge an EMI for 2 years. So that meant that only interest came in on those debt, and the sort of projected yield was higher for investors. But 2 years later, HDFC said, "Look, boss, now I need to charge EMI," and then all the cash flow went away, and the yield sort of still stayed the same, because although the rents had gone up by 5%, the yield was still the same. So for the longest time, the stock didn't move. So stuff like this, if somebody needs to understand and figure out that there is sort of corporate governance or some sort of a risk in these things. That is number one risk. The other bigger risk which investors usually have is capital sort of preservation, right? In every investment we make, especially in debt, we don't want our capital to go down below what we bought things for. When I buy a government security, yes, it can go down if interest rates go up, but if I hold to maturity, my face value will come back to me. I know that, plus interest rate. And here, like you rightly pointed out, the two measures that you can look at is the beta and the correlation. So both of which are very low in this case. And we just look at that graph we had about 100 rupees going to 224 and 100 going to 186. There has been very few days or months in those 6-7 years when it has actually gone below your capital value, because the returns are almost 80% from the yield and only 20% from capital appreciation. And therefore, it's a fairly stable product. So I feel like there is a risk of sort of losing capital a little bit in case you buy at a peak and then the sort of stocks crash or interest rates could go up, and therefore yields are higher in the market. So these things also trade higher. But in today's market, in a sort of interest rate scenario where it's going down instead of up, this is the right sort of time to buy these assets at.
Sure. While for India, InvlTs and REITs is at a nascent stage, and obviously, given the overall, I would say, understanding and the need and the policy push from government, and obviously the realistic need and the rising, I would say, investor base in terms of Indian savings culture getting transformed into informed investing. Obviously, REITs has a very optimistic future. But if one has to learn, from the history of how REITs and InvlTs have performed globally, and if you have to answer this question from the point of view of the type of investors who eventually, you think based on the global understanding would come and invest, it's like, I'm just trying to correlate this question to one of the questions asked by someone in the chat. He says that, can I comfortably retire by putting, say, my retirement corpus into REIT and expect quarterly payouts? So can this instrument turn out as a post-retirement instrument, from Indian point of view? Or what are the other, I would say, avenues which you have seen globally, which have led to the inflow coming from the retail side of investors? Like obviously, family offices and institutions, mutual funds definitely have a mandate and they will be investing. But from the point of view of the HNI, ultra HNI clients, what are the what is a global learning, which has led to the inflow coming to this side? Or, if it is that money has always come from majorly institutions and HNI, ultra HNI, even in the developed countries have kind of not invested much in REITs and InvlTs. If that is the case, then obviously, I want you to kind of highlight that. But if it is otherwise, then what is the goal? What are the kind of investors, or what is the kind of a corpus from investors' portfolio which ultimately goes to this kind of instrument?
You asked a lot of questions there in that one statement, so I'll have to think about how to answer each of them. First, interestingly, you spoke about the global sort of market. Interestingly enough, we have another product for global REITs, which we've been running for the last 2 years. So the first year we did on 30%, where we track globally listed REITs in the US, Canada, and Europe. And we have a portfolio of those REITs that we buy for our investors. And some of them are quite valuable, obviously. And of course, there's a huge currency upside there, which investors have enjoyed over the last couple of years. So, when it's REITs, we look at not just India REITs, but we've been looking at REITs throughout the world, not just here. REITs first were pioneered by the US in the 1970s. That's how REITs started. The first REIT came in 1970s. If you look at our market, $45 billion of market cap. The US REIT market is 1 trillion. It's huge. Everything that can be monetized has been monetized there. Casinos, land, farmland, offices, of course, retail, warehouses, hundreds and thousands of REITs available in that market. To answer the second question, who the kind of investors have been, which I answered also at the beginning, the great thing about this product is I'm a guy who's just started a family. I'm in my 30s, just married, have one child, maybe one on the way. I want to have income after 15, 20 years when my child goes to university. This is a great product for that. You can put in monthly, you can put in quarterly, you can put a lump sum amount, you can invest over time. The volatility is less, the compounded returns are great, and the chances of you losing your capital very low. If you look at somebody in their 40s with only 10 years of retirement left, again, a great product, because you know that if I put in every month, I will reach a stage where this 6-7% will grow to 8-9-10% in the next 10 years as rents go up and my yields go up. If I bought the embassy stock at 300 when the yield was 7%, today at 400, the yield is 7%, which is, let's say, 28 rupees. That 28 rupees on 300 is 10%. So the guy who had bought embassy at 2019 is sitting at a 10% yield right now. His 7 has gone to 10 in 6 years. If I hold it for another 5 years, I'll have 13-14% return on my original investment. That's a great retirement annuity income that I can get. If you are in your 60s, just retired, great. You can have like 8-9% returns every quarter paid to you. I think that was the question that was asked on your chat. Absolutely, you can invest your retirement corpus and you can expect quarterly rent out payouts here of 7-8% for a very long time. And at the same time, you want to go on a holiday after 2-3 years on a cruise, fantastic. You sell a little bit of that because there's market appreciation as well, and you can use that corpus to then go ahead and spend it on discretionary sort of spending. So it sort of appeals to a large section of investors throughout the 30 to the retiree stage, given the way it sort of is structured as a coupon bearing instrument and capital appreciation.
Bang on, Kunal. I think this is a product which has a great potential to disrupt the fixed income market in India, and absolutely, I agree with you on all the aspects that you have discussed. And absolutely, investors need to be aware about the expectations in terms of liquidity, in terms of net returns, net of fees and taxes, and on all these aspects. Once investors kind of will understand and will compare this to the traditional fixed income instruments and debt mutual funds, this instrument definitely holds a potential and holds, I would say, space in HNI investors and a true alternate to some of these traditionally popular fixed income products. And hence, I'm really keen to further explore this. And thank you so much for your time. It has been really, I think, interesting and insightful. Anyone who has any other questions which we have not been able to answer, given the 60 minutes time limit that we had for this webinar, we're happy to answer those questions. And you can write an email to me at kamal@pmsafworld.com, or you can kind of come to our website pmsafworld.com and book an appointment with us. We are more than happy and keen to address any of your concerns. The presentation that you had shared, Kunal, was very interesting. We'll be sending the presentation to all the attendees of this webinar on email shortly. And in case after going to the presentation, you want to ask any questions, most welcome to come back. Thank you so much for your time for logging in for this webinar today. Thank you.
I think the some people said that the note was not very clear, and you mentioned that there's a PPT and a PDF conversion. So apologies for that. But if you can also mail, like you said, mail it to them, then they can probably have a read of this note on their own, which is a lot sort of clearer. Or they can go to our website altinvest.ai, where this is also available, so they can also see that. But thank you so much for that.
Thank you so much. Thanks. Thank you everyone for joining.